get started with the topics presentation. First of all, if some of you don't know me, Mathieu Martin, I'm the portfolio manager of the Rivemont MicroCap Fund. I've been investing in the microcap sector for about 12 years now. Initially as a full-time private investor, I basically taught myself how to invest by reading books, talking with people, having mentors, attending conferences, lots of trial and error. And eventually, I enrolled in the CFA program, got my CFA charter. So I have more of the, let's say, academic background now. And I became portfolio manager of the Rivemont MicroCap Fund after. I also write a newsletter on Substack called Stocks and Stones. It's a free newsletter, so if anybody's interested, I encourage you to sign up. I share some of my thoughts on the Canadian microcap space. So I'll give you a quick recap of our year with the Rivemont MicroCap Fund. 2025 was a solid year, 25.6% net return. That's after all the fees. It was actually our second strong year in a row. So we followed up with 25.6% after a year that the fund was up almost 93% in 2024. So, pretty happy with the performance these last couple of years. Assets under management have increased to 15 million now. Our top performer in the portfolio was D-Box, which is a company that you will hear present tonight. The return on this position was 213% for us based on our cost base, and we still own the full position. We haven't sold shares yet. And lastly, and I'm going to talk a bit more about it later, but we had one portfolio company that was acquired in December called Montreal Cannabis. So I'll just give you a quick snapshot of the investment strategy. I'll keep it fairly simple, but when I look at a new opportunity, typically, there are three pillars that I assess. There's the business quality, the management team, and the valuation. Ideally, I want a company that meets all of these criteria. The unfortunate thing is that in Canadian microcaps, it's hard to find these opportunities. That's why I run a concentrated portfolio, 15 to 20 stocks, over 50% in 5 stocks, because these opportunities are rare. So what happens when a company doesn't meet all the 3 criteria, when something's missing? You can see on the chart that there are some overlapping areas between the circles. So if a company is missing the valuation part, that means I think it's overvalued. It can be a great business led by a great management team, but if it's overvalued, typically I'm gonna wait it out. It's gonna become a watch list candidate for me. And these watch list candidates, I tend to follow them as if it were a portfolio company. So I'm gonna keep in touch with management. I'm gonna update my financial model. I'm gonna follow it very closely. And hopefully at some point in the future, if the stock gets discounted for some reason, could be a bad quarter, for example, I'm gonna be ready to pull the trigger right away. The second bucket at the bottom would be a company with a great management team, great valuation, but a poor moat or a low quality business. So these opportunities, I see them as commodity businesses. Doesn't mean they necessarily sell an actual commodity, but commoditized product or service. They don't do anything very special, unique. They don't have a strong secret sauce, if you will. So these opportunities, I see it more as a potential trade. If the price is right and I can see some of the upcoming catalysts that could induce a re-rating in the stock, I'm gonna buy them and hold them for a few weeks to a few months. And then the last category, which I think is super interesting, is a high quality business at a great price, but it has a bad management team. So these opportunities that are mismanaged, typically for me it's off limit. If I can trust the management team, I don't invest. But these opportunities are ripe for activism. I'm not personally an activist investor, but sometimes there are other activists in the market that get involved in some of these opportunities. D-Box was a good example of that a few years ago when an activist came on the board. I think D-Box is a quality business. It was trading at a good price. And when the activist came on board and started to change things at the company and eventually replace the management team, that's when the company met my 3 criteria. And the returns can be really attractive when you find these opportunities early. Now, switching gears a little bit, I'll talk about some of the key themes that I'm watching in 2026. And these are more macro topics. One thing that changed a little bit in my process in 2025 was paying a bit more attention to the macro picture. And the reason is with the new administration in the US, things are changing so quickly. I hope everybody had a good day in the market today, by the way. It's like things are so unpredictable. So you kind of have to pay a bit more attention to that. So I'll just go over some of the topics that I've been following. First of all, rising geopolitical tensions, mostly originating out of the US, tensions with China, that's been ongoing for a while. We saw the military intervention in Venezuela, now Groenland. So I think you have to pay attention to these topics to figure out, where you want to invest your capital and maybe be cognizant of some of the risks that could be involved depending on where in the world you invest. Second thing, we're in an all-asset bull market right now. I put a few charts on the screen, but I could have put many more charts. So just for example, gold, silver, stocks at all-time highs. Even like I saw an article recently about Montreal real estate being up 67% in 5 years. I mean, all the assets are going up, and I think that's an indication that people see inflation as persistent going forward, and maybe a potential for currency devaluation at some point, or more severe, I should say, currency devaluation. So again, something to keep in mind. And the last trend that I've been following is on the consumer spending side. There's a concept called the K-shaped economy. Essentially what that means is like the shape of the letter K, there's one leg going up, one leg going down. So the leg that's going down in this current economy is low-income workers, small corporations, some industries that are heavily affected by some of the trade policies and those kinds of things. This bucket is spending less and gravitating more towards value or discounted offerings. And at the other end of the spectrum, you have the groups that are doing well. They're actually doing really well. Asset owners, high-income workers, large corporations. These groups are spending more and more, and they're keeping the economy afloat. So if you look at aggregate data, the economy seems fine. But if you look underneath the surface, the reality is very different for these two groups. And what you have in the middle is a big gap that's getting larger every day. So I call it rising inequality essentially. And I think you have to be cognizant of that when you invest in consumer good companies, because I think you want to be positioned at either end of the spectrum, not necessarily in the middle. So some takeaways for how I want to position my portfolio going forward. Fairly simple. I want to own hard assets. So invest in companies that own their real estate, that own manufacturing assets. Some would say, old economy businesses. And some of these businesses have been unloved and have been cheap for a while now. So I think could be a good time to look at these types of opportunities. The other is, companies that benefit from rising commodity prices. doesn't mean necessarily producers. It could be service providers, picks and shovel plays on commodity businesses. And again, going back to the K-shaped economy, companies that are serving the value part of the market or the premium part of the market. And by the way, D-Box is a good example of that, serving the premium consumers. And what to avoid, I would say anything that's subject to tariffs or trade wars. This has been in my playbook for since Trump was elected last year. Also, I think you have to be careful with capital-light businesses unless they have a strong moat and can pass on inflation to their customers. Otherwise, without hard assets to insulate them from inflation, it might be a bit more risky. The threats of AI are also ever present. We've seen a significant compression in SaaS or software multiples in 2025. So I think the narrative will probably stay negative for this part of the market for some time. So I wouldn't necessarily allocate new capital there for the moment. So let's move on to, I have two topics for you to share today, companies that are not presenting, but that I wanted to highlight. First one, Cannara Biotech, love on the TSX Venture. I'm sure many of you won't be surprised to hear that because I've been very vocal about my interest in the cannabis space and Cannara in the last year. So it's a company that we bought. We actually started buying it in the MicroCap Fund at about 70 cents a share, averaged up to about $1.30 our average cost. And actually, the stock had a really good day today, so it's the price is a bit higher than $1.80. But for the purpose of this presentation, let's say market cap is about 175 million. So Cannara, I won't go. I won't do a deep dive because we don't have the time. But just high level, Cannara is one of the emerging leaders in Canadian cannabis, 7th largest licensed producer in Canada, first in Quebec. They own 2 manufacture or cultivation assets. They have a large-scale asset in Valleyfield. And they also have a processing center and R&D center in Farnham. So they own the real estate, both of their buildings, which I think is, clearly fits my thesis about hard assets. And the company is also only using about 50% of its production capacity. So over time, they have the ability to scale with the existing assets that they own. This is actually a slide from Cannara's investor deck that shows the top 10 licensed producers in Canada by sales. And if you look at the last column, it's the year-over-year revenue growth. And you can see I put red circles for Cannara and Auxly. These are the 2 fastest growing LPs in the top 10. And they are also the 2 most profitable. So I think for me, it's increasingly obvious who are the winners in Canadian cannabis today. I know in the past, the industry has had not necessarily the best reputation. Lots of capital has been destroyed in this industry. But now, if you look at the data and the numbers, I think it's fairly clear who's emerging as the winners. And Cannara is one, and you'll hear Auxly after my presentation. I think is another strong company to consider as well. Last thing I'll mention on cannabis, M&A. We had one of our cannabis stocks was acquired in December, a company called Montreal Cannabis. They were acquired by Canopy Growth for an 82% premium. And the 3 main reasons why I think Canopy made this move. First of all, Canopy went asset light a few years ago, and MTL owned its cultivation assets. And I think Canopy wanted to get back into the cultivation game. So I think that's part of the reason, the fact that MTL owned its assets. The other one, cheap valuation. Canopy paid 12 times EBITDA. That's after the premium that was offered. So MTL was trading probably around 7 times before the acquisition. So I think it shows that the sector is discounted and there are lots of opportunities because most of the other LPs also trade at these depressed valuations. And lastly, management team, the MTL management team was strong, and I think Canopy wanted to get its hands on this talent. So any cannabis operator today that has cultivation assets, a cheap valuation, and a strong management team, I think is a potential acquisition candidate. So just to recap, Cannara targets premium customers. That fits one of the my thesis around consumer spending. They own their assets. The assets are probably worth more than the current enterprise value. There's no tariff risk. 100% domestic business. Clear runway for growth and cheap valuation. Now let's move on to topic number 2. Company called Kits Eye Care. Kits on the TSX. This one has been a core position in our portfolio since 2024. We bought it at an average price of $7.50. Almost a triple for us at the current price. But I think there's still plenty of upside left on this one. So very simple business. Kits makes eye care easy. So they sell contact lenses and glasses online, direct to consumer, through their website, kits.ca or kits.com. And they're basically disrupting the traditional brick and mortar store in this industry. This is the slide that tells the whole story. That's the revenue by quarter. So you can see nice, consistent, solid revenue growth every quarter, 20 to 40% year-over-year growth year-over-year, every quarter like clockwork. The company has a 31% revenue CAGR over 3 years. They're growing 10 times faster than the industry because the category is increasingly moving online. And also one thing I'll highlight is the EBITDA margin. I'm not sure if you see it well, but it's the last line at the bottom of the slide. The EBITDA margin, let's say 3 years ago, was in the 1 to 2% range, and it's increased to the 5 to 7% range today. And the management team has guided to 15% or more EBITDA margin at scale in the long run. So the way I view it, maybe a bit similar to Amazon in the early days, always reinvesting in customer acquisition, delighting the customers, investing in the customer experience, faster delivery, all that stuff. I think Kits is using the same playbook. They're not optimizing for near-term profitability. So I think you have to look at it on a revenue multiple at this point, not an EBITDA multiple. So valuation, about 3 times revenue currently. If you assume 15% EBITDA margin at scale, that means about 20 times EBITDA. Is it fair? Everyone can make its own interpretation. I think if the company can keep growing 20 to 30% per year, I would argue this is still cheap. And if you assume a constant multiple over time, your returns should match the revenue growth in the business. So I think very good returns to be had here over the next several years. Besides the valuation, they target the value consumers. They offer some of the lowest prices on the market for glasses. It's a category that's recession resistant. I think even if we had a recession, some consumers would probably trade down to cheaper options. So Kits would probably benefit. So it makes the portfolio a little bit more anti-fragile. And lastly, they own manufacturing assets in Vancouver. They built their own optical lab to manufacture the lenses. And I think that's a competitive differentiator for them, because a lot of players in the industry outsource the manufacturing, and some of them even outsource to China, which is becoming a bit of a problem, as you can imagine. So I think it is very, very well positioned to succeed in the long run. And that's it. And I think I have maybe a couple minutes for questions.